Welcome back, my awesome people. In today's episode, I will be discussing whether or not you should invest during a recession, like the one we're currently in. The impact of this recession has not been felt yet, as many people are still getting aid and grants due to COVID. But eventually, most likely mid-2023, society will start to feel the negative effects of the recession. And who knows, by then, things could go worse and we end up in a depression. I won't be going into details between the difference of a recession and a depression in this video, but if you want a simplified explanation, check out my video, this one, where I discuss the differences, the pros and cons, and how to make money in both scenarios. So, check it out. A recession refers to a period of declining GDP and is generally defined as a sustained decline for 2 or more consecutive quarters. Recessions aren't just about poor economic growth. They are often accompanied by several other characteristics, such as widespread job losses, fewer available jobs, and more government relief, such as stimulant payments and increased unemployment benefits. With all that in mind, you may wonder if investing is a good idea if we're in a recession. Is it wiser to take every dollar you make and keep it in cash? Well, during a recession, stock values often decline. In theory, that's bad news for an existing portfolio, but lower stock values offer a solid opportunity to invest in great companies cheaply or to average down stocks that you already own. During a recession, investors need to act cautiously but remain vigilant in monitoring the market landscape for opportunities to pick up high-quality assets at discounted prices. These are difficult environments, but they also come with the best opportunities. In a recession, the worst performing assets are highly leveraged, cyclical, and speculative assets. Companies that fall into any of these categories can be risky for investors because of the potential they could go bankrupt. And investors who want to survive and thrive during a recession will invest in high quality companies that have strong balance sheets, low debt, good cash flow, and are in industries that historically do well during tough economic times. Knowing which assets to avoid investing in can be just as important to an investor during a recession as knowing which companies make good investments. As I mentioned earlier, the companies and assets with the biggest risk during a recession are those that are highly leveraged, cyclical, and speculative. And what are these stocks? Well, during a recession, most investors would be wise to avoid highly leveraged companies that have huge debt loads on their balance sheet. The more leveraged a company is, the more vulnerable it can be to tightening credit conditions when a recession hits. While these companies are struggling to make their debt payments, they are also faced with a decrease in revenue brought about by the recession. The likelihood of bankruptcy is higher for such companies than those with lower debt loads. Cyclical stocks are often tied to employment and consumer confidence. Cyclical stocks tend to do well during boom times when consumers have more discretionary income to spend on non-essential or luxury items. Examples would be companies that manufacture high-end cars, furniture, or clothing. When the economy falters, consumers typically cut back their spending on these type of expenses. They reduce spending on things like travel, restaurants, and leisure services. Because of this, cyclical stocks in these industries tend to suffer, making them less attractive investments for investors during a recession. And finally, speculative stocks. Speculative stocks are based on optimism among the shareholder base. The optimism is tested during recessions, and these assets are typically the worst performers in a recession. Speculative stocks have not yet proven their value and are often seen as under the radar opportunities by investors looking to get in on the ground floor of the next big investment opportunity. But these high-risk stocks often fall the fastest during a recession as investors pull their money from the market and rush towards safer investments that limit their exposure during market turbulence. So those are the 3 types of stocks that you need to stay away from during a recession. If you have a high risk tolerance and you want to cash in on these stocks when they are beaten up during a recession and hopefully see a high return when the recession passes over, then totally go for it, because I personally am down quite a bit for my speculative stocks. But I have been buying more at these near zero prices and patiently waiting for the recession to pass over. I could possibly see my speculative stocks hit zero and lose all my money, but I could possibly also see them triple in value. But that is all dependent on one's risk tolerance. I will be posting my speculative portfolio in the next few days, so subscribe to get notified. Hey, my awesome people, if this video gave you something to think about or something to put on your watch list, subscribe to the channel to get all my updates and investments. And follow me on Twitter at Jacob Rant and on Instagram. And if you want $25 of real cash money for free to buy your favorite stocks, sign up with my Wealthsimple link down in the description box below and start investing. Now that you have a better idea of the type of stocks to stay away from during a recession, here are the type of stocks that you should move towards to protect not only your portfolio, but your peace of mind. While it might be tempting to ride out a recession with no exposure to stocks, investors may find themselves missing out on some significant opportunities if they do so. A good investment strategy during a recession is to look for companies that are maintaining strong balance sheets or steady business models despite the economic headwinds. Some examples of these companies include utilities, basic consumer goods, and defense stocks. In anticipation of weakening economic conditions, investors often add exposure to these groups in their portfolios, as these companies are less vulnerable to tightening credit conditions and have an easier time managing the debt they do have. By studying a company's financial reports, you can determine if they have low debt, healthy cash flows, and are generating a profit. These are all factors to consider before making an investment. While it might seem surprising, some industries perform quite well during recessions. Investors looking for an investment strategy during market downturns often add stocks from some of these recession-resistant industries to their portfolios, such as counter-cyclical stocks that tend to do well during recessions because their demand tends to increase when incomes fall. The stock price for counter-cyclical stocks generally moves in the opposite direction of the prevailing economic trend. During a recession, these stocks increase in value. During an expansion, they decrease as consumers now move towards cyclical stocks as they have more money during an economic expansion. And non-cyclical companies see an increase in demand when consumers cut back on more expensive goods or brands or seek relief and security from fear and uncertainty. These outperformers generally include companies in the following industries, such as consumer staples, grocery stores, discount stores, firearm and ammunition makers, alcohol manufacturers, cosmetics, and funeral services. Once the economy starts moving from a recession to a recovery, investors should adjust their strategies. The best performers are those highly leveraged, cyclical, and speculative companies that survive the recession. As economic conditions normalize, they are the first to bounce back and benefit from increasing enthusiasm and optimism as the recovery takes hold. Another great investing strategy during a recession is getting income from your stocks. If your investing strategy includes passive income and not just growth, you can look to dividend yielding stocks during recessions because they offer cash payments regardless of the market's condition. Dividend stocks are shares of a company that splits a portion of its profit with all its shareholders based on the number of shares each investor owns. So, investing in companies with a strong record of paying dividends can lead to stable cash flow even during recessions. Even if the value of your stock is down because of the conditions, the reinvested dividends lower the volatility. Let's say your stock is down 10%, but that stock you have pays a dividend of 3%. If that gets reinvested, you don't experience as much downside. When searching for dividend-paying stocks, it's important to know that yield shouldn't be the biggest determining factor, as the highest yield tend to come with additional risk. Rather, look for consistency in paying or increasing dividends. This indicates good corporate governance. Regardless of whether you're investing in stocks, real estate, bonds, or even sports cards, make sure that you have your life in order first. What I mean is, investing during a recession can be an amazing idea, but only once you have fully funded your emergency fund, which is a savings of cash that can keep you afloat for at least 4 to 8 months. So if you lose your job or an emergency comes around, You will have an emergency fund that can still pay your monthly expenses to live while you get back on your feet. You should always aim to have enough money in the bank to cover at least 6 months of living expenses. Once you're there and have extra money at your disposal, then you can feel free to invest it. If not, be sure to build a solid emergency fund first. So, Jacob Rant, what are you doing during this recession? Are you investing? Watching? What's your game plan? Well, my awesome people, investing during a recession isn't for the faint of heart. You may think you're buying at a low, only to see your portfolio value decline a few days later. The best way to avoid losses in a recession and come out ahead is to take a long-term approach to investing. It can be a great idea to invest during a recession, but only if you're in a strong enough financial position to do so, and only if you have the right attitude and approach. Remember that if you're hurting financially, there's no shame in missing out on an investing opportunity. Instead, focus on paying your bills and staying physically and mentally healthy. You can always ramp up your investments at a later point in life, once your job is more secure, your earnings are steady, and your mind is more at ease on the whole. The bottom line is that during recessions, it's important to stay the course. It becomes a bit more important to focus on top quality companies in turbulent times. But for the most part, you should approach investing in a recession in the same manner you would approach investing at any other time. Buy high quality companies or funds and hold on to them for as long as they stay that way. And remember, my awesome people, just like all the information I mentioned in my videos, please do your own due diligence because I'm just a clown on YouTube. And again, if you are watching this video and do not have a Wealthsimple trade account and you want free money to trade with and $0 commission fees that won't eat into your profit, sign up with my Wealthsimple link down in the description box below for $25 of free real money. Link is below. So again, I am not a financial advisor, so make sure you do your own research and consult your own financial professional. Thanks. There is so much wealth out there for all of us to get a piece of. So by allowing our hard-earned money make us more money is the key to wealth and the key to financial success. Subscribe, like, and share to help out this channel, and so you will get notified of when I post my penny stocks, my REITs, my dividend stocks, my speculative stocks, and any other investments that I'm buying or selling. I want everyone to get out of this work-life trap by buying back their freedom through investing. So let's all ride together on a journey of health, love, success. So until the next video, stay ranting.